Hello, welcome once again. This is Dr. Fred Sutton, and today I'll be reviewing the adjusting process here with adjusting entries. All right, so really we have to take a look at 5 categories that we must adjust. So at the end of the month or the end of the period, we must adjust certain things because certain things have not been accounted for during that time frame. So we must then do that at the end of the accounting period. So in here I have, as you can see, prepaid expenses, unearned revenues, accrued expenses, and depreciation. So the first one, we take a look here, I'm going to kind of walk through what each of these are and kind of give you an example of what they are as you make those adjustments. So prepaid expenses here, if we look here, it may be prepaid insurance. So prepaid insurance is one that you may have as a part of this. Because what happens here is that we prepay our insurance. Many of us may prepay our insurance for 6 months. So we use up some of that. 1 month has expired, so therefore we only have 5 months left of that prepaid. Now, unearned revenues could be something from, maybe it's unearned rent. So that could be unearned rent. And what that means is basically somebody, another company or a business may have paid 3 months in advance for rents. And 1 month has now expired, so I've used one of those months and I still have 2 months remaining. So we have to make the adjusting entries there. Now we may have some accrued revenues. And so what those accrued revenues are, maybe we have, we've done part of a job. So we have, maybe it's a 6-month job, a construction job, and we've completed 1 month of that. So that might be a revenue that's accrued. So we may have an accrued revenue here, as you can see. And then you may have some accrued expenses too, as a part of that. Now in your accrued expenses, those could be such as wages. So that wages may fall into that there for you. So wages, because not everything works out perfectly, where at the end of the week, at the end of the year ends up perfect on that, and December 31st ends up on a Friday. No, sometimes it ends up on a Thursday, a Tuesday, and a Monday. And so then we have some accrued expenses there. We have accrued some expenses, but we have not made those payments for those. And so that's what that's about. And then depreciation, because now we've used another year or another month of depreciation. So in that we now have to basically journalize those. So depreciation could be for depreciation of building. All right, so let's talk about these. I'll just walk through some examples of this. So in the prepaid expenses here, we have a prepaid insurance. So what we can have here is if you remember correctly from the video from debits and credits, you'll remember that the expenses will typically be a debit. So we have prepaid insurance that we're going to be taking it away from. So we'll have a prepaid insurance, that will be we'll have that as our credit, so for $100, and then we will have a debit of insurance expense. For $100. And I'll spread this out a little bit so you guys can see that a little better. So as you can see here, I have now taken some of this was an asset, removed $100 out of that asset and moved it into expense now because we have used it. So that's what we have done with this transaction. This also could be done with supplies too, because sometimes we go over to a business and buy supplies. Maybe we buy $1,000 worth of supplies, and at the end of the month we've used $100. We find out we have $900 left of those supplies in there. So what we would do then is have supplies expense. And then we'd have supplies. We are then going to credit our asset, take away $100 from our asset, and then move and have $100 in our expenses because we've used up some of our supplies. So that is your prepaid expenses side. Now moving on to your unearned revenues, you may have unearned rent. So I gave you that example of unearned rent. So basically what unearned rent is, it's actually a liability. We have collected money, but we haven't done the work for it yet, or the time has not expired for it yet. So in unearned rent, the time has not expired. So therefore, we must then, since we've moved 1 more month closer to that, and we've used up some of that, now we have earned some of that. So what we'll have here is you'll have, this is typically a credit balance. So what we're going to do here is then debit it for that $120, and then we'll have rent revenue that we'll be moving it into for that $120. So as you can see here, I've taken away from a liability and then added to a revenue account. So now I have less of that. So if I had three months with $360 and $120 a month, we used $120. I pulled $120 out of that liability, so at least be $240 left in that under rent. And then the next month, I will use another $120, leaving me $120 for the last month. And these will all move into the rent revenue category there. So next is the accrued revenues. So the accrued revenues is for maybe a job that we're working on. Maybe it's a construction job and I'm doing landscaping for the company. So the landscaping for this company here that we're doing for this company that we're doing it for, we may have finished a portion of that project. And maybe we finished half of it during the time. So we've accrued some revenues there. So in that accrued revenues, we then must realize some of those revenues there as a part of it. So part of it then will go into our accounts receivable. So our accounts receivable will go up, and maybe it's $500. And then we'd have our revenues, our, we'll call it fees earned, for this one here, for $500. Oops. So as you can see here, what we're doing is I've added to an asset, and then also added to my revenue side here. So I have a debit of accounts receivable for $500, and then a credit for fees earned for $500. All right, moving over to here, I'm going to drop this down a little bit so we can see a little better on our wages. Now let's say my employees get paid $1,000 per week. That's how much we pay them, the whole group of them. Yes, that's not a lot. But we're going to figure out that basically at the end of the year ends up to being a Tuesday. So December 31st is Tuesday. So I have accrued Monday and Tuesday worth of wages for them. So if I pay them $1,000, I divide that by 5 for 5 days a week. That means that they get paid $200 a day. So because I get paid $200 a day, I have 2 days that Monday and Tuesday have accrued. I must then make my adjusting entry at the close of the year at this point. So as a part of this, then I have a wages payable commitment that I need to pay them for that. And that wages payable is for $400. Then I will also have wages expense. So I have wages expense, and that will be my debit of $400, and then wages payable will be my credit for $400. So what happens here is the end of that Friday comes along, and that's our payday. We will pay the $1,000 to them, and we'll pay off this $400 as a part of it, and then we'll pay the next 3 days in addition to that. And then this $400 is in our wages expense for that year. So that is our adjusting entry to complete that for that year. And then finally over here we have depreciation expense here. So over the time we have depreciations, maybe we depreciate our building, and we depreciate, let's say, $1,000 a month. So I'm going to do a depreciation expense there, and then I'm going to have accumulated depreciation. So as a part of that, I'm going to bring this all the way down here, and so that will be depreciation expense for $1,000, and then I will have accumulated depreciation for $1,000. So as you can see, these are the 5 areas that we must adjust at the end of the month, or at the end of the period, or in the year, whichever it is when we are doing our adjusting entries. I hope you've enjoyed this video today. This is the adjusting entries, and my name is Dr. Fred Sutton. Thank you and take care.